In the previous lesson, you learned how to read candlestick patterns. But here's the truth. Candles alone are not enough. You need to know where to use them, because a perfect candlestick pattern in the wrong place will fail. And a simple pattern at the right level can become a high probability trade. That's why in this lesson, you're going to learn one of the most important foundations in trading: support and resistance. Look at this chart example. As you can see, the market moved up, reached this level, and then reversed. It came back to the same level again, formed a Nagaraboshi candlestick, and as a result, the market moved down. Now look at another chart. The market reached a level, reversed, then came back again and formed a doji candlestick. And what happened? The market moved up. So why does the market react so strongly at these levels and move toward the target? Because these are what we call strong key support and resistance levels. And if you know how to identify and draw them correctly, you'll already be ahead of 90% of traders. Here's what you will learn in this video: how to identify strong and weak support and resistance, why most traders draw levels the wrong way, how price reacts at key levels, what buyer and seller behavior really looks like, how support becomes resistance and the opposite, how to find high probability trade entries, how to avoid false signals using price action. At the end of this video, you will be able to spot, draw, and trade support and resistance with candlestick patterns. Before we dive in, if you want to learn more powerful trading lessons and price action techniques, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next lesson. Now, let's get started. To identify a strong support or resistance level, there are 6 key criteria you need to follow. Major swing highs and swing lows. Start by focusing on the most significant turning points on the chart. A strong support or resistance level is always built around a clear rejection zone, either the highest peak or the lowest point of a recent price movement. These extremes reveal where buyers or sellers stepped in with strength, and this is why price often comes back to react at these same levels again. Multiple price rejections. A level gains strength every time price reacts to it. When the market tests the same zone multiple times without breaking through, it signals that strong players are actively protecting that area. You can think of it like a barrier. The more times price hits it and gets rejected, the more powerful and reliable that level becomes. The level must be obvious. A strong level should be easy to recognize at first glance. If you have to force it or look too hard to find it, then it's probably not a valid level. The best support and resistance zones are the ones that stand out immediately when you open the chart. Simple, clean, and clear. Strong and aggressive reactions. When price moves away from a level with speed and momentum, forming large candles and sharp movements, it indicates strong buying or selling pressure. The more powerful the reaction, the more significant that level becomes. These explosive moves often reveal where institutions have entered the market and left their footprint. Role reversal. This is one of the strongest confirmations you can get. When a resistance level is broken and later acts as support, it shows that the level is valid and respected by the market. The same principle works in the opposite direction. This type of behavior is a clear sign of smart money activity. Recent respect of the level. Fresh levels are always more relevant than older ones. A level that has been tested recently carries more significance than one formed a long time ago. The market reacts to current conditions, not outdated price action. That's why you should always prioritize the most recent reactions when marking your levels. Before moving forward, there's an important point to keep in mind. A support or resistance level doesn't have to satisfy all 6 criteria to be considered valid. However, the more criteria a level meets, the stronger and more reliable it becomes. Let's jump into real examples and break it down step by step. Look at this chart. As you can see, the market reached this level and reversed. It moved up again, tested the same level, and reversed once more. So we draw this level. Now the question is this a strong support or resistance level? Yes, it is, because it is clearly visible and price has already rejected it multiple times, first here and then here. This tells us we are dealing with a high-quality resistance level, so when the market approaches this level again, we expect another rejection to the downside. Now look at what happens next. Price returns to the level, gets rejected again, sweeps liquidity above it, and then moves down as expected. Now look at another chart example. Here the market was trending down, then reached this level and reversed. This is a key support level. You might be asking, why? First, the level is obvious. You don't need to spend time searching for it. It stands out immediately. Second, it has been respected recently, which means it is still fresh and relevant. Third, it aligns with a major swing low, while the level above represents a major swing high. With these criteria combined, we can say this is a high-quality support level. Now look at what happens next. As you can see, when the market returned to this level, it was rejected once again and moved upward as expected. Now look at this chart example. As you can see, the market reached this level and reversed, forming a clear resistance level. This is a key resistance level because it is obvious, it aligns with a swing high, and it has been respected recently. So, naturally, when price comes back to this level, we expect a rejection. But look at what happens next. Price returns to the level, and instead of reversing, it keeps moving up. So the question is, if this level meets the criteria of a high-quality level, why didn't it work? The answer is simple. A key level on its own is not enough. A support or resistance level is just an area where price has a higher probability of reacting, but it does not guarantee a reversal. That's why we need additional confirmation before entering a trade. And one of the best tools you can use is what you learned in the previous lesson, candlestick patterns. A support or resistance level shows us key areas of interest in the market, and candlestick patterns show us how price is likely to react at those areas. Now let's combine candlestick patterns with support and resistance to see how it works. Look at this chart example. As you can see, the market is trending down. The market breaks below this support level and then retraces back to it. The support level becomes resistance, and once price retraces back to it, a doji candlestick pattern forms. After the doji formation, the market moves down. Here we have another support level that was broken, and the market is retracing back to it. So this support level has turned into resistance, and we will see how the market reacts to it. As you can see, the market retraces back to this support level that has become resistance, and look at what happens. The market forms a clear Nagaraboshi candlestick pattern. Now look at what happens next. As you can see, the market moves down as expected. So why did this key resistance level work? First, because it is an obvious level. Second, because it meets one of the strongest criteria, which is role reversal. This means that the support level was broken and then turned into resistance, in line with the downtrend. But that alone is not enough. It only tells us that this is a high-quality area. When the market retraces back to it, a Nagaraboshi candlestick pattern appears. This validates the level because the Nagaraboshi indicates that buyers tried to push the market higher to break the level, but they failed, and the market closed below it. The Nagaraboshi confirms this area and shows that this resistance level marks the end of the retracement move and the beginning of a new impulsive move